From the library of the New York Stock Exchange, at the corner of Wall and Broad Streets in New York City, you're inside the Ice House, our podcast from Intercontinental Exchange on markets, leadership, and vision in global business. The dream drivers that have made the NYSE an indispensable institution for global growth for more than 225 years. Each week, we feature stories of those who hatch plans, create jobs, and harness the engine of capitalism. Right here, right now, at the NYSE and at ICE's 12 exchanges and 7 clearinghouses around the world. Now here's your host, Josh King, Head of Communications at Intercontinental Exchange.
According to the International Energy Agency, nearly 96 million barrels of crude oil were produced each day in 2016 globally, and that number is expected to cross 100 million in 2021. Oil and refined products are still one of the most highly imported products for the United States, and laws were recently changed to allow the U.S. to export more of its rapidly growing shale oil production to refineries around the world. Because of its extensive use, the price of crude oil and the fundamentals that drive the global oil market are critically important to businesses and consumers around the globe. Our guest today, Ed Morse, an energy market economist and currently global head of commodities research at Citigroup in New York. He's responsible for advising investors and companies around the world on fundamentals affecting the global energy markets. Our conversation with Ed right after this.
Inside the Ice House was brought to you this week by Norwegian Cruise Line, NYSE listed NCLH. Norwegian Cruise Line's 16th ship, Norwegian Bliss, will begin cruising Alaska and the Caribbean seasonally in June 2018. For more information, visit www.ncl.com.
With over 45 years of experience in energy markets and international affairs, Ed Morse is one of the most highly respected energy analysts and an expert in the fundamentals driving global energy markets. In 2007 and 2008, when oil prices reached near record high levels, Ed was a leading voice arguing that prices were at an unsustainable level, and looking back, history proved him right. He's taught international relations at Princeton University, served as the Deputy Assistant Secretary of State for International Energy Policy, worked for oil companies, and built world-class teams of analysts covering the constantly evolving energy markets. Ed Morse, welcome to the Ice House.
Nice to be with you.
How does someone become an energy market economist, and why does a bank like Citibank need one?
Yeah, well, how one becomes one is different from how I became one.
Tell us.
So I was a kind of geeky guy, and I decided to get a PhD, and then I decided to teach. So I luckily was teaching at a time when oil markets, among other commodity markets, were in turmoil. This was in the middle of the 1970s. It was during, in fact, the period in which there was an OPEC oil embargo on the U.S. and the Netherlands. Oil prices shot up fourfold in a very short period of time.
Gas lines, Jimmy Carter's Oval Office addresses.
I was on gas lines, so I remember them well. And yeah, all of that was happening. It was before Jimmy Carter was elected. So I got involved in it indirectly. And then eventually worked for the State Department as the kind of the top level person whose full-time job was looking at energy markets, representing the U.S. When I started negotiating oil and gas issues with other countries, I saw theory and practice kind of merging together. I saw reality changing in front of me, and that was it. So I've done it ever since.
State Department, what administration?
I was actually a political appointee in both the Carter and the Reagan administrations. There was a little continuity for a bunch of reasons that would not likely happen these days.
Your political leanings must have meant a lot less than your expertise.
Yeah, and I think that was it. So I was involved in the transition to a new Secretary of State. It was Al Haig, and he and his people appreciated...
Ed Muskie to Al Haig, right? Was Muskie the last Carter's last secretary?
He was, yeah. And those briefings were something that he appreciated, and he had the White House trying to replace me with some political appointee, and he didn't want somebody who he might be uncomfortable with sitting on that desk, so I stayed there for a while.
So what were sort of the pivotal moments, either at that desk or after leaving the department, that sort of imbued this level of passion for this area of the energy industry, of which you are such a leader now?
So I think what I felt most compelling was change. And you remarked earlier about a call that I had in 2008 on the unsustainability of $100 plus oil prices. And that was partly because I had lived through change, and partly because I went from the State Department at a time when the U.S. was just beginning to fill the Strategic Petroleum Reserve. It was a reserve of a capacity of 730 million barrels of oil. We had almost no oil in it at all, and nobody who was sensible thought the U.S. would ever be able to buy oil to put in the strategic stockpile. And I left the State Department having been involved in the first negotiations to put oil in the strategic stockpile. It was a deal done between the U.S. government and the Mexican government. And the reason this happened was that all of the assumptions that everyone had in the market then, that prices were going to go up continuously, started to break down. We saw really emerging the first of a wave, a tidal wave of new oil coming into the market. And although I had thought about cyclicality, nobody was thinking about cycles. And all of a sudden it dawned on me that commodities were a cyclical business, and a viciously cyclical business. And all of a sudden, when you were worried about, whether from a policy perspective or then working in an oil company responsible for telling the people in the oil company where prices were going, that this was a roller coaster. And it required preparation for the roller coaster. And as I lived through many roller coaster rides, I learned that the structure of the business changed with each roller coaster ride, and that led me to, and I think it's the edge that either I have or that others who work for me have had, namely that I look for discontinuities. I don't think about momentum as something that's permanent. I think about yesterday as being different from tomorrow, not as a precursor or a predictor of what tomorrow will be like.
What have been the various stages that you've seen from the 90s and then into the aughts and then into the teens that talk about the different ways in which we should think about the oil marketplace?
Sure. So I got into my interest in this business came as OPEC became something important. And I was teaching, too. So I had a student who wrote a thesis, and the thesis was about when the U.S. was the big guy in the oil sector and when the U.S. was the swing producer, having shut-in capacity to produce. And that was a function of low prices and a function of the Texas Railroad Commission and the fact that places in Texas, like the Permian Basin, which is very much in the news today, were the largest source of supply in the world market. There was rationing that took place in order for prices to stay at a higher level than the market would clear at. And then OPEC kind of followed that. Going from 1980 to 1985, there were two really remarkable aspects of the oil industry that I lived through as I was either in the government or in an oil company. One of them was that OPEC really changes in its complexion over time. So if we look at 1981, to pick a date, OPEC's production capacity was about 35 million barrels a day. Incidentally, it's about 35 million barrels a day today. Saudi Arabia in 1981 produced the highest level that it had ever produced, around 10.7 million barrels a day in the summer of 1981. And then you fast forward, it's actually a very fast ride, from 1981 to 1985, oil demand actually fell by 5 million barrels a day. Unheard of. Nobody thought oil demand was going to fall.
Why was that?
So there were two things going on. One was in the markets where demand was growing in the world as a whole at around 7.5% per annum, which means it doubled every 10 years. So you get to a point in the middle of the 1970s when oil production in the world was about 33 million a day, and you project forward it's going to be 66 million a day. It hit 66 million a day actually, or 65 and a half in 1981, and then it fell. Why did it fall? So people thought it was because of a recession at the time, but in hindsight, it was because what I call frenetic fixed asset investment was taking place before 1973. It was taking place in the U.S. partly because of the build out of a continental-wide road network. And we had this kind of continental-wide system feeding into gasoline demand. But Europe and Japan in the industrial world were seeing 10% per annum demand growth. That was all related to infrastructure development in Europe and Japan, like we had infrastructure development in the U.S., except in Europe and Japan it was reconstruction from World War II. And guess what? 1973, 74, when the Arab oil embargo took place and oil prices went up, frenetic fixed asset investment came to a halt because it was all done. And you didn't need 20+% fixed asset investment. And so you can ratchet a little bit forward on this. China, 20 years between 1990 and 2010, saw oil demand growth of more than 10% per year. And you try to think about what caused it. It was frenetic fixed asset investment. The Chinese side was not an interstate highway system or reconstruction. It was urbanization. Let's build at least 10 cities a year of 1 million people or more and do it for 20 plus years. And then say all of a sudden like that, hey, we're not going to do it anymore. So when that happens, demand comes to a roaring stop. And in Europe and in Japan, in the middle of the 1970s, when fixed asset investment came to an end, demand growth came to an end. So you take the original 6 members of the European Economic Community, and their oil demand now is what it was in the middle of the 1970s.
Are there other places on the planet that will experience what happened in North America, Europe, and Asia during the periods that you talked about? Do you see new spikes, or is it going to be a long, gradual decline?
I think it's going to be a long, gradual, slow growth. It'll decline eventually, but we're not seeing dramatic growth. We're seeing a dramatic increase in the efficiency of the world to use energy, and with that, a decline, whether in an emerging market or in an advanced economy, a decline in the energy intensity of GDP growth. So just to put a number out, for the world as a whole, when I first got involved in this, there was more than a one-to-one relationship between GDP growth and oil demand growth, and now there's less than 0.5% relationship between the two.
Take us through your day. What are the first tools, screens, and pieces of information you use to assess where the oil market is and where it's going?
So the first thing I do is I have a Reuters screen and a Bloomberg screen, and I got to see what the headlines are, and that's where the day starts. So you have to assess headlines. Sometimes the headlines relate to Iran or geopolitical issues, and you've got to, think through them. Sometimes they relate to a deal between Russia and Saudi Arabia that may be extended or not. What is it that is driving momentum, and what is it that's driving change? And the change really can be abrupt and big. And the change that we focus on most of the time now is on the supply side, not the demand side. You have to be cynical on the demand side. And I think the lesson learned there is that when you see a sharp drop in prices, you can't get all bulled up and say, my God, oil demand growth is going to return and it's going to be twice what it was last year because of lower prices. And I think the big change is kind of summed up in that we are now in an age of energy abundance. There is likely to be not much on the horizon that's going to change that energy abundance. And that energy abundance really has changed the way the energy sector works. It's a highly politicized sector. There's politics and economics at work at the same time. On the political side, I'd say the big lesson is that there are always winners and losers in the geopolitics of oil and the geopolitics of energy more broadly. But the winners and losers change a bit over time, and the structure of them changes. So you need to look at the market to figure out where the winners and losers are. What happened in the last decade, not the current decade, but the one before this, was that prices went up. They went up very high. Capital spending went up because people thought the peak oil was here. And there was investment and technology that was changing. And the investment was obviously in shale, because we think about that given the headlines in the country we live in. But it also was in deep water, and it also was in in oil sands, and it challenged somebody's way of life, namely OPEC's way of life. And it did so for a structural reason that's kind of neat when you think about it. If we had a map of the world and made it flat the way a map is, and we had in the middle of that flat map the Middle East and Central Asia and Russia, and to the left side was the Atlantic Basin, to the right side the Pacific Basin, you really had two basins that were in supply deficit. So if you were in the surplus area, the Middle East and Central Asia and Russia, you were the supplier to the world. But all of this new supply, whether it was shale or whether it was deep water or whether it was oil sands, came out of the Western Hemisphere. None of it fed into the Pacific Basin. It all fed into the Atlantic Basin. And then all of a sudden, the world did not have two deficit areas because the Atlantic Basin became surplus. It had one. And that meant a battle for market share in the Pacific Basin. And the first part of that battle was Saudi Arabia saying we lost market share, which they did dramatically, both in the two largest oil importing countries in the world, the U.S. and China. And they decided they couldn't fight back for market share in the U.S., except they could destroy U.S. production, they thought, by bringing prices down by overproducing. And turning to the Pacific Basin in China, they thought that they could get their market share back, particularly because they thought, like the U.S., the Russian energy industry was high cost and was going to crumble, like the U.S. energy industry would under a low-price environment. And that turned out to be a lesson that they were burned by, because the ruble is really not anything other than an oil currency, and it is tied dramatically closely to the price of oil. The price of oil goes up, the ruble goes up. The price of oil goes down, the ruble goes down. And when the ruble goes down, the Russians earn more money at a lower price than almost anyone else. And the cost of the production, which is mostly ruble denominated, plunges so they can invest more. And rather than their production disappearing, it grew, and meant that the Saudis, looking at the market, looked at a fact that historically becomes obvious. Their production capacity in 1981 for OPEC as a whole was the same as it is today. And the world's demand for oil, as I said, fell to 60 million barrels a day and is now closer to 100 than it was to the 96 that it was in 2016. So OPEC hasn't grown. And in order to market intervene, they need assistance, because the role of OPEC is now less than half of the market rather than more than half of the market. So they had to form an alliance with Russia that had a government with an interest in trying to stem the tide of these new sources of supply. But higher prices have really made these robust. And an interesting aspect of that robustness is 2014 was when the Saudis increased production, brought the price of oil down. But shale and oil sands and deep water had a role to play, because that was a year where demand grew by about 1.5 million barrels a day. And these three countries that had deep water, shale, and oil sands, Canada, Brazil, and the U.S., added 2.3 million barrels a day to the market, also helping the market to soften and made the Atlantic Basin a surplus basin. Saudi Arabia and Russia got prices back up. But as we look at this year, 2018, we expect about 2.5 million barrels a day of liquids coming out of the U.S., Canada, and Brazil. So they're now in a very different position of winning and losing, and trying to push the burden of adjustment onto consuming countries that are now also producing countries. And it's a very different world as a result of that.
So sorting through the winners and the losers, Ed Morse, you were talking about the beginning of your day, looking at the Bloomberg screen, the Reuters screen. If you have another corner of your eye that you can go to that TV in your study, and you can see the Saudi Crown Prince Mohammed bin Salman on his tour of the United States, New York, Washington, D.C., Silicon Valley. What did the moves that he has made since being made the Crown Prince last year through the present tell you about what the Saudis are thinking about the future of energy production, their opportunities in oil, and where they need to expand their economy?
Sure. So most obviously was the plan for 2030 to get off of the morphine of living on an oil economy and finding ways to get it to grow. And I'd say if we look at winners and losers, potentially, the Saudis have to be way up there on the winning column because of all the petrostates in the world. In an era where I'd say we're in the era of the failure of the petrostate, of all the petrostates in the world, the Saudis are the ones that have self-consciously tried to find a roadmap to find new sources of employment, find new sources for the private sector, which has been crowded out by the public sector, and to do that at the same time that they find more value in the resource base that they had. So when MBS articulated the plans for both 2020 and 2030 at first, he looked into the future and clearly came to the conclusion that the net present value of oil in the ground is no longer higher than taking it out of the ground. I'd say that puts them closer to the winning column of a set of tasks that's very difficult to achieve. But unless you have a roadmap and unless you have it as an objective, you won't be able to achieve it. And I think the really big difference between the Saudis and the Russians as petrostates is, however much Russia may be better endowed in human capital and in technology, they've done nothing to move away from being an economy and a government dependent on oil and gas revenue. And the other one has done a lot.
Let's turn a little bit to U.S. energy policy. We started our conversation mentioning that you worked in both the Ed Muskie State Department and the Al Haig State Department. There have been many state departments and many administrations since then. If you think about the beginning of 2009, President Obama comes into the office. One of the first trips he makes is to a solar energy manufacturer and stands in front of the solar panels and declares, green energy is going to be our future. And if you think about one of the major points of contention in the 2016 campaign, Hillary Clinton, Donald Trump, the question of whether big coal can ever be revived. How would you gauge the difference in rhetoric from one administration to the other and in actual fact?
Yeah, so they're both really stark in the differences between them and the differences between rhetoric and reality. So here we have the former President Obama, who certainly was sensitive on the green side, and many of the main supporters that he had before he was first elected were what we call green energy people. So he started and ended with that objective in mind, namely to accelerate the reduction in dependence on dirty resources and accelerate the increase of dependence on cleaner resources. At the same time, no matter what the rhetoric was, the market was at work, and the market turned out to be pretty powerful because it was in the Obama administration that the shale revolution really unfolded, and unfolded because of the compelling combination of entrepreneurial, independent companies in the U.S. oil and gas patch, combined with the financial services sector that could provide capital to these poorly capitalized companies, given the risk reward for that capital to make through greater production. And we had one other thing in this country, namely, almost uniquely on the planet, an ability of private parties to own resources under the ground. So that combination and the high prices that were there, relatively speaking, at the beginning of the Obama administration, really is what created the shale revolution. And he might not have liked it, and he might not have appreciated what was going on. He did, however, sign a bill to end all of the obstructions against U.S. oil exports. So
thus raising all the incentives for these types of extraction processes.
Significantly raising them and and actually changing the U.S. From being a declining oil and gas producing country to be the fastest growing one in the world. And once the export restrictions were removed, the fastest growing exporting country in the world. It is kind of factual that the increase in U.S. exports of crude oil, petroleum products, and natural gas liquids last year was bigger than global demand growth, like 1.7 million barrels a day, a stunning number. So we have this contrast between the objectives of the government and what the market is doing. Similarly, I think with the Trump administration, yes, there is the rhetoric of U.S. energy dominance, but what does that mean when the U.S. has no state levers to use oil or gas as an instrument of public policy? So I don't know how you articulate a meaning for policy from the concept of energy dominance, although the U.S. has become a bigger player in the market than it otherwise had been. And just to give you a notion of that, by the end of this year, if we look at all liquids produced by the U.S. sector, natural gas liquids turning into things like propane and ethane, oil, crude oil, biofuels, by the end of this year, the U.S. will be producing 50% more liquids than both Russia and Saudi Arabia. So it's not something that we normally think about, but it's been a dramatic change. President Trump started by liking dirty energy and particularly liking coal. But the fact of the matter is that it will be hard to find the board of directors of a utility anywhere in the United States that will take on the potential liabilities of building a new coal-fired generating power plant. And there is every incentive when these 50 or 60-year-old plants come to the end of the useful life not to put capital into them to lengthen their days, but rather to replace them with something else. So no matter what public policy says about coal, coal usage in the U.S., which has fallen by over 30% from the beginning of this decade to now, and is going to continue to fall at a fairly rapid rate, particularly because the U.S. is not consuming grid energy at a faster rate. We're consuming grid energy at a lower level than we used to. It's renewables that are in the kind of distributed energy business that provide an ability for a university or a big retail chain to fuel themselves with solar panels and wind turbines, doing it off-grid, maybe selling some of it onto the grid, and even in a
residential, commercial power generation just for the purposes in a very localized area.
Yeah. And yes, we'll have a big spurt of power demand again with electric vehicles when and if they come of age, but it's not going to happen between now and 2020.
Are there things that investors that you listen to, read, follow, and then also provide guidance to, what would they say the Trump administration and government should turn their sights on, the most effective things that they should do for national energy policy that they're not doing now?
Yeah, well, I think that there has been a growing popularity within corporate America and within governments within America to take seriously climate change, take seriously the need for cleaner energy, and companies have their own behavior. It's hard to find a bank that'll lend anything to a new coal mining venture. And there are multiple reasons for that, and maybe it's self-defense in some cases against shareholder preferences, but the government can't do anything to change what companies want to do. Sustainability has become a theme of the public and of companies, and I think it's not reversible. I think that's the underlying trend line, and it's such that it's really hard, whether you look at pushing coal again to have more employment in coal mining, or whether you're pushing to keep fuel efficiency standards at a lower level than a higher level. It's hard to stop the momentum, whether it's in the U.S. or any other country.
We're with Ed Morse. He's the global head of commodities research at Citigroup. After the break, we'll continue our conversation with Ed talking about the mechanisms that set global oil prices.
Norwegian Cruise Line's Norwegian Bliss will feature the largest racetrack at sea, incredible entertainment including the Tony Award-winning musical Jersey Boys, as well as 2 180-degree observation lounges, perfect for whale watching in Alaska or taking in sunsets in the Caribbean. To learn more, visit www.ncl.com.
Back now with Ed Morse, global head of commodities research for Citigroup. Ed, what is your sort of frequency of output? You mentioned your sort of rhythm as you get into the office. How often are you communicating to investors and in what form? And are you passionate about writing and sharing information about where the industry is headed?
Yes, I'd say there's not enough time to write the things we want to write. And my team and I are fairly prolix in what we put out. Some of it is because we regularly have to do it, so we regularly have to think. We follow financial flows in and out of commodity markets. Financial flows in and out of energy markets and oil markets in particular are near and dear to the ICE, near and dear to the markets. And I'd say it's the most fascinating part of the market in terms of price setting as well. So if we look at financial flows, they're very fickle, and you can't follow momentum in them a lot. If you look at the net length of managed money on both of the big exchanges, you can see that at the moment we're at a combination of the two exchanges at about the record ever. There is a tight correlation between the net length of managed money and the price of oil, and unless you have your eyes fixed on that, you can get burned as an investor in the market. So we spend a significant amount of time trying to think of the drivers of short positions and long positions in the market and who is putting them on. And the one thing that's really clear is that when you're at a record level of length, it's not going to last forever. This is a real roller coaster, and the turning points happen just like that. Market sentiment can change on a dime. Market sentiment at the moment is very bullish for geopolitical risk purposes. May is a month of phenomenal geopolitical risk in the markets in general, but the oil markets in particular. The month of May sees a deadline on the JCPOA agreement with Iran. It has elections in Venezuela. It has elections in Iraq. May is also the month when the presidents or the heads of state of both North Korea and the United States have decided to get together. There's a lot of geopolitical risk in the consequences of the month of May. If we get through the month of May with a sigh of relief, there's bound to be a sell-off. How the sell-off materializes is hard to know. The financial market, which is something we have to think about every day, and particularly every weekend, because we put out a report on this every Monday. And we put out the report because there is reporting both from the ICE itself and from the CFTC on the position of people in the market from the week before. But we also look at stats, and stats are high frequency. We have both high frequency and low frequency statistics coming into the market every week. Typically, we have weekly data from the United States, from Japan, from observers of independent storage in Northwest Europe, in the Caribbean, and in Singapore. And the market is fixated on the issue of whether Saudi Arabia and Russia and the rest of OPEC are bringing inventories down or whether inventories are rising. And we kind of project out, as I said earlier, this 2.5 million barrels a day potentially of production growth from the U.S., from Canada and Brazil, which will be at some point in time adding to inventory. And we suspect when the market sees U.S. drilling rates continuing to rise and inventory starting to rise, there's going to be a big sell-off from this managed money at its record level of net length, combined with less geopolitical risk. And we think that's going to bring prices down. So we have to kind of watch this weekly, bearing in mind that we're looking at turning points, and we expect that the turning points are going to be what they are directionally, but we just don't get the timing exactly right in advance, so we have to monitor it all the time.
Bringing prices down. Let's talk about benchmarking for a minute. You're known for your extensive research into crude oil benchmarks. For the uninitiated, we're talking about bringing prices down. What is a benchmark and how does it affect the pricing of oil?
So a benchmark is a crude stream normally traded on an exchange that is used to set the value of other crude streams. So we have two major benchmarks, the largest of which is the ICE Brent benchmark. What's critical to the market is the spread between Brent and something else, whether it's Urals, whether it's another benchmark. The benchmark is the price setter. It's the price setter that you look at in two different regards. One is in the exchange market itself, what's the difference between today's price and tomorrow's price? And therefore, what is the structure of the forward curve? So the benchmark is pretty critical to that. When the benchmark is higher priced than the nearby contracts, that shows you that the world market is pretty tight. If the benchmark is lower priced than the next month and the month after that, that's an indication of softness in the market. When the two big benchmarks, WTI and Brent, which are mostly lookalike crudes, differ from one another, both the nature of that differential and the nature of the change in the structure of both of them, which I suspect is going to be very different at some point this year, where we think Brent will stay backwardated and we think WTI will be in contango. You need to, for investment purposes, have a critical eye on what those benchmarks are and their relationship over time to one another and themselves.
So thinking about ICE Brent and gas oil as global benchmarks, are there any recent or future changes that you've seen day to day, week to week, month to month that should drive our thinking around those products?
We have in recent days seen a new benchmark being tried on an international exchange. It's the new Shanghai exchange, where liquidity seems to be growing in leaps and bounds, where the Chinese government is very much behind the exchange, unlike the exchanges on which oil is otherwise traded, which were evolutions of a market, not government diktat. The irony is that the world thought, the market thought, that the two benchmarks, particularly Brent, which is used more than WTI is in contract terms by sellers of crude oil, they thought that these were anomalies. They were light sweet crude in a world dominated by heavier crude. Every heavier, more sour crude benchmark that's been tried has failed for one or another reason. The market is evolving where the incremental barrel these days is light and sweet. So it's probably going to prolong the existing benchmark and will likely make it even more difficult for the sour crude benchmarks that China is trying to float or that Russia is trying to float to be able to succeed. The other one, gas oil, is really interesting these days in that for most of the last 20 years, particularly up until 2011, the product line that saw the major growth was gas oil. And it was thought that it was going to be the critical product in the product markets. Then for 5 years after the decade turned, gas oil demand stopped growing. It was supposed to be the leader in growth. But now it's growing again at a very fast rate for reasons that you've got to keep your eye on, are hard to think through, and are happening at a time when in less than 2 years, on January 1st, 2020, marine gas oil standards change to a low sulfur gas oil standard. And it's not clear that the refining system in the world can make enough of that. And I suspect that benchmark is going to become again more critical and have more market eyes on it.
So Ed, just taking a quick trip back in history, in 1920, the U.S. enacted the Jones Act, also known as the Merchant Marine Act of 1920. It required goods shipped between the U.S. ports to be transported on ships that are built, owned, and operated by U.S. citizens or permanent residents. Can you talk about the way that the Jones Act has affected U.S. oil market dynamics?
Sure, it's been another distortion in the market, a massive distortion when you think about what the objective of the Jones Act was. It was post-World War I, and it was designed to preserve the dominance of the U.S. merchant marine fleet, which was the dominant fleet in the world. And what it did was accelerate the decline of the U.S. Position in the world of shipping. So we have a law that was designed partly for national security purposes, partly for intervening in the market purposes, and it didn't really play as big a role in either, and has this distorting effect. And the distorting effect was also for a while in the grain markets as well as the oil markets, because shipments of grain under the PL 480 program, U.S. aid to subsidize farmers effectively, had to be shipped on these vessels also, which are more expensive to own and operate than non-Jones Act vessels and non-U.S. flag vessels, both. What this has meant is that it is often cheaper for a refiner on the East Coast to, or the West Coast, to bring in crude from afar, from another country, than it is to bring crude in from the U.S., unless there's a pipeline that at times when, for emergency reasons, like a hurricane, you can't get enough product through a pipeline from where the product is produced on the U.S. Gulf Coast to the deficit markets on the.
It's a huge issue in Puerto
So
Rico.
it's an issue, a very big issue in Puerto Rico, but it was a big issue in Hurricane Sandy. And it just has a distortionary impact. The interest groups where the shipyards are, having an alliance here between Rhode Island, Mississippi, and California to put three odd couples together, is maybe it's more a menage a trois than an odd couple, but it's it's strange. Strange bedfellows are made by politics and the desire to keep, for defense purposes, this industry means keeping the Jones Act going, and it's just like the renewable fuel standards, which has winners and losers. Winners in Iowa and the Corn Belt, losers in the independent refiners. Just as that is hard to overturn and make it more rational, so too this is hard to overturn.
Can you talk about some of the trends that you're seeing in Asian oil markets and in refined production that we didn't touch on earlier? I mean, you've got ongoing communication between Xi Jinping and President Trump and how that will play out over the next 12 to 24 months.
Yeah, I don't know how that plays out. There's brinksmanship going on in the trade part of the world, and that brinksmanship can be very dangerous. We don't know what happens if one or another party doesn't blink, and where the party waging the trade war goes if the trade war can't be won. But the underlying trend in China is diversification of sources of supply, and the market is working there too. I noted earlier in our conversation that U.S. exports grew by 1.7 million barrels a day in 2017. The largest growth of that came in the Chinese market, where the U.S. A month and a half ago was exporting about 500,000 barrels a day of crude oil to China, and the demand among the refiners in China for light sweet crude is quite high, and where earlier conversations between President Trump and Xi led to a view that there was going to be a Chinese welcoming of U.S. LNG exports, and indeed, next to Mexico, which is the largest recipient of U.S. LNG, China's like number two in terms of buyers of LNG. Maybe that had to do with dramatic shortages over the winter of gas in the Chinese market, but the U.S. is incrementally on the precipice of becoming the largest incremental supplier of LNG to the world, and that will go to China as well. So, ironically, the U.S. has taken a lot of the market share of the producers that have cut back, and that changes the dynamics of the market, and price determination in the market. So the U.S. Is becoming much more of a price maker in the market by virtue of the supply growth than it has been any time since maybe the early 1970s.
So whether crude oil production ever gets to 100 million barrels a day by 2021 or grows at a more gradual pace, we're going to continue to depend on analysis of experts like Ed Morse and his team to help us to continue to sift through the political, economic, and even production and transportation issues that drive the cost of what we pay for a barrel of oil or a gallon of gas, now or in the future. Thanks, Ed, for joining us in the Ice House.
And thanks for having me here.
That's our conversation for this week. Our guest was Ed Morse, Global Head of Commodities Research at Citigroup. If you like what you heard, please rate us on iTunes so other folks know where to find us. If you've got a comment or a question you'd like one of our experts to tackle on a future show, email us at icehouse@theice.com or tweet at us at NYSE. Our show was produced by Damon Level, Pete Ash, and Ian Wolfe, with production assistance from Ken Abel. I'm Josh King, your host, signing off from the Library of the New York Stock Exchange. Thanks for listening. See you next week.
Information contained in this podcast was obtained in part from publicly available sources and not independently verified. Neither ICE nor its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of this information, and do not sponsor, approve, or endorse any of the content herein, all of which is presented solely for informational and educational purposes. Nothing herein constitutes an offer to sell or a solicitation of an offer to buy any security or recommendation of any security or trading practice.